Welcome everyone to this weekly trading roadmap. So we're going to go through like every week the event-driven risks that we're going to see during the week, and then take a look at a very rough risk and money management plan. See how we can kind of position ourselves and potentially manage ourselves throughout the week and throughout these events that we have. So coming into Monday, first and foremost, we've got the European, or we've had actually, because I'm recording this just after the event, the European CPI estimate year on year. That came in at a minus 0.2% versus 0% expected. So we've actually seen a push lower in inflation, the actual CPI print. And if you actually look, I think the core figure year on year, if I'm not mistaken, was at 0.8% versus 0.9%. So that's come down even further. And I mix that in with the inflation expectations, which have actually been plummeting as of recently. We can really get the sense that the ECB is going to have to do something very, very, very big to change the market's perception of where inflation is going at the minute, because it's very, very dire. So that is what we've seen so far today. We also have later on today the U.S. Chicago PMI, not the biggest market mover anymore, but worth looking at. That is traditionally the figure that people look at right before we look at the month ends, or start looking for month end flows, especially in the bond market. We also have the U.S. pending home sales today. Now onto this figure, onto this event, we've got the month ends today, which for the German, well actually just for the European bond markets, I think the pan-European aggregate extension or duration extension that we've seen Citigroup come out with was a plus 0.1 years. So that's pretty big. Usually an average is about 0.07. So 0.06, 0.07 is about average. This is relatively big. So no surprise, we're actually seeing quite a decent amount of flow today already in some of these core fixed income products. The bunds, the oats have been quite bid. So quite interesting little dynamic there, and something you guys should be taking a look at. Obviously, then we also have the month-end flows for the MOCs in the equities as well. So stay tuned for that today. So overall, high relevance for today. Give myself 25% risk allocation. I don't give myself generally one of the highest risk allocations for the week on Monday, because traditionally on Monday I don't perform as well as on the rest of the week. But given we've got a few little things happening on Monday, and I'm sure a lot of the traders we have FuTechs as well have been prepped for, I've given myself a little bit more risk allocation for today, especially with month ends, which is traditionally something we trade quite well here at FuTechs. Now, moving on to Tuesday, we've got the RBA cash target rate, so keep an eye out for that. We've actually seen a bit of an offer. I was looking at this morning with Mr. Brannigan Barrett. If you're looking at the Aussie dollar, has actually come off of quite an important 200-day moving average. I don't have that up at the minute, but hopefully I can just bring that up for you guys in a little second. If it doesn't take me too long to bring up. But interesting here, we've had a bit of an offer, a bearish engulfing day. We've come off a 200-day moving average. So maybe a little bit of pricing in of potentially some sort of move out of the RBA, but keep an eye out for that tomorrow. We also have the UK PMI manufacturing on Tuesday, and then the US ISM manufacturing. Give myself overall medium relevance and 20% risk allocation for Tuesday. Wednesday, you've got the UK construction PMIs and then the US ADP employment. ADP, yes, the market does move off of it, but seeing as non-farm payrolls is not, the biggest continuation type move anymore, the market isn't paying attention to that as much. The ADP's kind of fizzled down, so I've given myself low relevance for that day and minor risk allocation, so 10%. I mean, I can shift this as and when if I see the right setups and whatnot during the week. However, this is just my template for just keeping an eye on how I'm going to manage my money throughout the week. If I see something where the conditions change on a Wednesday, there's a very amazing setup, maybe I'll give up maybe 2% or 3% from each day here, give myself a little bit more for Wednesday, and such that I can trade those. But overall for the events, I'm giving myself about 10%, if I had to compare that or relatively to the other days. Thursday, we've got the UK service PMI and the US ISM non-manufacturing. So again, medium risk allocation. medium relevance and 20% risk allocation, similar to Tuesday. And then on Friday with the U.S. non-farm payrolls, the NFP, I haven't bolded that if you haven't noticed here. I haven't actually put that in bold, but I've put what is important for me in bold, the average hourly earnings. I think I've been mentioning this pretty much every week, but non-farm payrolls, for me at least, yes, there is some pretty incredible moves, and you get some good, blips here and there in every market, but this is noise. Not to say it's not amazing to trade. I generally do think non-farm payrolls is a great figure to trade, but if you want to pay attention to what's actually making a difference to market expectations and what the funds, the big institutions, are trading off of, you need to take into much more consideration the average hourly earnings, which is effectively a gauge of inflation in the U.S. Without earnings inflation, without people making more money, you can't possibly get sort of well-grounded, solid inflation in the economy. So that is effectively why the Fed look at this so much. High relevance for Friday and 25% risk allocation. So if you can see, guys, overall on the week, if I had a profile, I've got pretty much my highest risk allocation, at the ends of the week. So it's something like this. That's kind of how my risk allocation is on the week. A little bit higher the start, gets a little bit lower, the lowest point here, and then towards the end of the week, give myself risk allocation. So maybe in the middle of the week, I might try and take it a little bit easier, watch my risk, watch my money, take slightly, smaller positions maybe, instead of trying to get too heavy in the market. So taking a look at some of the markets we generally look at, the bunds and the Euro stocks, which are the two main markets I trade. The bunds, in terms of structure, we did mention this last week in our weekly market wrap. For those of you that did listen in, we were generally looking at a bullish type move. The reason being, a reason why we were looking at that was, as we mentioned, we had this really big selling tail last week. Very little traded, 2 weeks ago, sorry. An area in which there was, big selling tail. And here, the market had come up into this region, spent a lot of time filling in that time, that lack of time value. So we had a lack of time value. We built that time value. We also had a lack of volume value, which again we built. So you can see we built volume value in this area as well. And being as we built that volume and time value in there, there was this double top. This region here, there was the 16s. Put that in a different color. With the 16s here, with the 25s here, the 166, sorry. 166 16s, 166 25s. I shouldn't actually be writing that as an S. I just do that because I say it that way. But 16 and 25, and which we actually did challenge this morning. Now, if you're watching your ladder very closely this morning, it was very interesting. Coming into the day, this is the structure we had on the day. So if you take a look at the structure overall, we could see we're very much coiled. We had two inside days. We had this inside day from here. This was technically within this range. So this range, this was an inside day number one. And then we had the second inside day over here. So two inside days coming into today. Quite a bit of a consolidation and build up of energy, a coil as we sometimes call it. The market opened up coming into today. We opened up around that region. I think it was around 09s, 10s, around here. We came up to about 14s to 13s. 13s was our inside day high. Went through by one tick, came down, and there was a really big absorber in here, in this area, like absorber over a few ticks, right? It was absorbing not only double O's, which was our VPOC of last week, just under that around 95s, 94s, 97s. And this whole region he kept just kind of absorbing. And then when we came and got back above these 05s, we just came bid and actually challenged those 25s. A very decent break in here at these 25s. We had a nice little move to the upside. And now, as you can see, we're building value just slightly higher now on the week, just above those 25. So very, very clear line in the sand, I think, trading today. What you want to be keep taking a look at and just keeping in mind is obviously these 25s. If we get through there, obviously your 13 is your next port of call. If we get through those 13s, well then, it's not looking too pretty. We might actually have a bit of a false break in which anyone that's gotten long aggressively in here might need to cover down to the downside. It's not a scenario I'm looking for as long as we're building value and holding above these 25s. For me, I think this market should test higher. It's a bit of a price discovery mode because in terms of price, this was the all-time high in price. We've now taken that out and we're just making more, higher and higher highs in price. We are not technically in our all-time low in yield yet, so this is very important to understand and understand the context of that. If we look at the yield chart, the market is now breaking down. We've come down and taken out this 13.4 basis point mark. You can see we're trading at around 11 basis points, and the low that I have, at least here on Reuters, is around 5 basis points. The all-time low in yield. So technically we're not in uncharted territory in the yield. Remember, in the 9-year part of the curve, we're already negative. So the 10-year is not too far away from that. We're 11 basis points away, which is really not that much at all. We could be within a point of the new all-time low in yield. So just keep that in mind now, guys, because really there's not much structure in this area. And if we can hold an offer, a bid above this area in price and an offer below this area in yield, technically we should be trying to go test that area out at least. So that is how we're looking like in the bunds. I think very interesting structure, very interesting little break that we had this morning. What I did want to note, coming back to what we said, and we note this every week, notice these are our inflation expectations. This is the move that we've had recently through those lows of 2015 at 1.48%. We've taken that out. We're moving to the downside. The ECB at this point are looking at this and saying, wow, the market isn't believing us at all. So, I really do think they need to come out with an extra large bazooka this time if they want to change the market's perception of where inflation is going. We're seeing lower inflation prints. Last week we had a bit of higher inflation in the PCEs. In the US, you could see there was some decent little signs of inflation picking up there, but in the European side, the other side of the pond, we're not actually seeing any of that pickup. So the ECB really need to do something big, in my opinion, if they want to change the market's perception. Because they're looking at this, just do not be surprised if they do something extravagant. Do not be surprised if they buy corporate bonds, if they buy, they increase QE by 20, 30 billion a month, if they decide, hey, our problem is in oil, let's buy oil futures. Something extremely ridiculous, out of this world. And they have to release something big. And I think the market's not, because they haven't been talking that much, they haven't been, bolstering their rhetoric too much. And really the only guys we've been listening to is kind of Weidman, which he's already a well-known hawk. He hasn't really said much. So, the well-known doves haven't come out and said anything big. Maybe they're trying to manage the market's expectations so when they do come out with their bazooka, the market does get surprised. Now, on the other hand, if they don't come out with something big and they do something just as expected, maybe another 10 basis point cut in the depo rate and a 10 billion increase in QE per month, I think the market's not going to be very happy with that at all. Especially another depo cut, that's going to possibly affect the banks even more. Your Deutsche Banks, all these banks have been getting hit recently. They could get hit even more if the depo rate gets plunged even into further negative territory. So do be aware, guys. We're in uncharted territory for global central banks. Almost as if the markets are kind of calling central banks bluffs here. So they're not really believing that much as they used to what the central banks were doing. So this is a very interesting time. We need to pay very close attention to how the markets react here. If there was ever going to be a sell-off based on a lack of confidence in the central banks, that would probably be the sell-off of all time. So I really don't think the central banks want that to happen. And that's why I really do think they have to do something big. Now, moving over to the stocks. I think it's a little bit more difficult to ascertain how this market's going to react this week, but we can just take a look at the very simple metrics and kind of understand, where the pinch points are and where we can start saying, okay, this might be a little bit more bullish, this might be a little bit more bearish. We've opened up dead center within last week's value area. So our value area high is at 29.46, value area low at 28.61. So these are our metrics from last week. You could see we've got a kind of a volume and value cave in here, which at the minute it seems like we're trying to fill out at this, a little bit lower than this area, but nonetheless, it comes all the way up, at least in time value, comes up to this closing gap at 29.15. Ultimately, for this to remain within value, not start tipping its hand to the bullish side, it has to remain below the VPOC of last week at 29.27. I think once we start breaching above and holding this, volume area here, this high volume zone, we start using that as support, we'll likely try and test this value area high at 29.46, in which case, if we break that, the first obviously area that we want to be taking a look at, we've got a bit of a selling tail in here with the 50% of that week coming in and single print at 29.59 and 29.60. Likely the market might want to actually spend a little bit of time in here before we break higher. I'm not sure, but that could be a scenario that I'm thinking about. If I am long and I'm looking for a break up higher, I'd rather wait and see and let the market tip its hand with a little bit more volume to the upside before I get involved there. To the downside, again, if we come down, test this value or low and break it, like Simon was saying today, there's a little bit of high volume here, higher volume at the top end of the day of the week last week. So a bit of that overhang of volume. Once we start breaching through this little higher end of volume and then get through this, low volume region, put this in a different color, this little low volume region in here with the value area low at 28.61. If we breach that area, breach it to the downside and use that area as resistance, this is very evenly traded all the way down to this low volume node at 28.27 region, where we just a little pickup in volume, and you can see a previous high of the day in there. So a bit of an interesting little area, and the value area low of the previous week. For me, if we start breaching below there, potentially I think it could swiftly move down to these 28.27. So just keep an eye out on that. And then obviously below that we've got the 27.99s, which is the low of last week, in which case if we take that out, then we're looking at a bit of a scenario where the markets come up, accumulated even more short positions, and anyone that's long may need to start covering. We might start looking for a move, a little bit more prolonged move, potentially back down to fill this closing gap at 27.59s, and through there obviously we've got the VPOC and the value area low of this week, which would be a pretty extended move down to 26.78. So that is potentially what we're looking like in the Euro stocks. If we had to just take a quick look over at the structure in the FX markets, we could see the Euro on the week. So if we just extend this a little bit further down the week, it's just hovering above that little bit of a consolidation zone in here, as you can see. This little bit of a flag slash wedge formation. We had the first initiative move up, we kind of consolidated, we moved back up. Now we've come to test this area again. We're not looking like we're really trying to hold a bid here yet. I'd say if we breach this area in here, it could likely be a pretty nice little swift move down to these 107.86s on the spot market. So keep an eye on that for that if you're looking at the Euro. Again, if we find a bid, get back above these 109.67s and hold, then potentially we might be looking again at some more moves back up to the upside. But it seems as if overall, the dollar is picking up a little bit of steam recently, so just keep an eye out for that in the markets at the minute. You can see, even if we look at the cable, which is obviously the weakest out of all FX majors at the minute, seems last week we saw a very, very extended move to the downside. This is last week's candle. Extended move. We've now taken out that low, trying to potentially make another move down. Remember, guys, in terms of context, we scrunch this up a little bit. Our next real levels, stem from our 2008, 2009 lows. So we've got these levels, 2009, we've got an area at 136.53, and then just below there, the low of literally the past decade is at these 134.98s on the spot market. So really for me, we are looking at a potentially big buying tail region. This has been a low for a very, very long time, which we saw a pretty decent move out of. Like I've said in previous streams, yes, we could very easily test these. I wouldn't expect them to just capitulate through it. Being as that's a very important area, if anything, if we're trying to make a move down, the same way we saw in the Bunds, but on the flip side, the Bunds had a structure where we came up, we tested an area, we came back down, we tested that area again, double topped, we built a lot of value in this previous selling tail area, and then we broke. Likewise, in this area, in this kind of structure, if we make a move down here, I would expect this to range a little bit, fill this area out that we haven't traded in quite a lot, and then make a move down. So just keep that context in mind if you're trading this even on a long term, and this is not really paying you off as quickly and as aggressively as you think it would. Just keep it in mind that these kind of structures, at least from my experience, I've seen that's kind of how they work, and that's kind of how I try and position myself and trade them accordingly. Looking over at the dollar yen, last week we actually caught a bit of a double bottom at these 110.98s. Just ahead of those 110.08s, which is that previous kind of swing high from 2014. You can see we're kind of held between these 110.98s and about the 114.87s now. It looks like this area is probably very lightly traded. If we had to build a profile around this, it looks something, that's a horrible line I just drew. So it's something like potentially a little bit more volume here. Sorry, a little less volume here, and then a lot of volume and value in there. So in this little area here, likely there's not much going on in that area. So it seems as if you can see in this little zone, we might be trying to just build a bit of volume and value. And technically, the way this is looking still for me looks overall in the medium term still looks bearish for this pair. Because if we're building volume and value in here, that just means we're accepting value in a lower region than when we were in before. And this is where we accepted value. Now we're accepting value a little lower. If we start breaching this area and moving down, we're getting back into previous value areas where we've traded before. So technically still looks bearish to me medium term. But, like I said, really, you can't really trade that aggressively until we start taking out this low in here that we made at 110.98. Right. What did I want to quickly show you guys? The Aussie dollar, which actually Brannigan had pointed out to me. This is the bearish engulfing. Let me just see if I can get a moving average. So simple. Do 200-day. Okay, there we go. So that was our reaction. This is our 200-day moving average. You can see it came in at 0.7258. As you guys can tell, Brannigan to point this out to me. I didn't actually notice this till he had said it to me last week. On the dailies, we didn't quite get there here. We came down a little bit, retested back higher, didn't quite touch it again, but again, we're very close. We haven't touched that 200-day moving average, if we really scrunch this down, in a very long time. As you can see, we haven't touched that in ages. I mean, very, very long time, since 2014. So we've come into that area right now. We've just nipped it. We've got the RBA coming out tomorrow. So just bear this in mind, guys. Technically structured. Got a bearish engulfing on the day just there. If we take a look at adding just maybe a bit of a ray here, that's how we're currently structured, with a bit of a trend line just poking out there. So if we have something considerably bearish for this pair, so we'd get a cut or whatever from the RBA, then look at this, this trend line in here, break of this with that impetus off the 200-day DMA, 200-day moving average. Well, then potentially we're looking at a bigger move to the downside, test some of these previous swing lows. So that's what we're looking at in the Aussie dollar. Now, if we take a quick look over at some of the commodities, and if you notice, I kind of structure this similar to my weekly wrap-ups, because I like to give the context at the beginning of the week, and then after that, at the end of the week, we can take a look at how we kind of fared compared to what I actually said and what we talked about in the beginning of the week. Looking at the gold market on a weekly time frame, we had that bit of a false break of that inside week at 1239. A bit of a false break. We're actually finding a bid on the week. You know, traditionally with this kind of setup, you would expect this to at least test this 1193. So I would still keep that in mind. But it looks like we're trying to find a bit of a bid back up in this region. What I would say is this candle now is now within the 2-weekly range. So the 2-weekly range is ultimately this. So again, you know, you could take it as we're getting a little bit of coiling in this market right in here. So you know, a break of either side of this little coil, whether it be here or here, you could see some decent upside or downside flows. So I would keep that in mind now for gold. Technically, for me, still looks medium-term bullish. We have started to accumulate and build positions, you know, above this building value above this previous key swing high from 2015. You know, like we said, we had that big break, the push of stops. We've come and tested down. We haven't quite gotten to the area we're looking at 1189s, but we stopped at 1193s, building a bit of value. If we can start finding impetus back up through these highs, you know, this could potentially start moving back up to these 1303s or even higher. So that's how we're looking at there. Obviously, the converse move is if we actually break and hold an offer below these levels here. What I did speak about last week in the wrap up is I was saying how this, if this is potentially, we've had this bearish downtrend here. If this is a change in trend here, I would normally take this move here to the high here as wave number 1, because when you change the direction in trend, that's when I start looking at a wave count, because I can start counting now from 1. Okay, we're potentially changing the trend here. If this is a wave 1, wave 2 usually has a pretty deep pullback. So yes, we are building value in here, but you know, don't be surprised. Even if we have like a pretty deep pullback, the best moves are when you get a really, really deep pullback so that everyone gets bearish again, and then we start lifting back up. That's when, if we get the, you know, the three, the so-called 3 move, which is the 3 wave is always the biggest wave. So I would keep this in mind overall on a bigger time frame structure. Just always keep that in mind. If we're changing trends, you know, and this is the first wave, keep an eye out, because the second wave can often retrace very deeply. Now, looking over at oil, which is very interesting structure, and we've been kind of talking about this since the beginning of the year. We have double bottom. The double bottom has not been confirmed yet. The confirmation of the double bottom comes when we break this region in here between, well, basically around 34 to about 34.82. The 34.82 is the most important level here. You can see we've double topped 34.82 level. If we take that level out, because now we've double bottomed at around 26 bucks. If we take this level out now, you know, I don't see a reason why this shouldn't trade up to 38, 39, in my opinion. And if we lift even above this key area, this 38, 39 region, with these lows in here and these highs in here, you know, and then we're breaking this falling wedge pattern, which we've been talking about literally since the beginning of the year. We break that falling wedge pattern somewhere in this region here. A break of that, you know, just expect the unexpected, you know, a move that could be very, very big, because, you know, through there's not really much structure till we get to this area in here. This is the next area in which we've got very strong structure. A little bit of volume traded here, a little bit in here, but overall I think it could trade all the way up to about the 43, 44 buck region quite easily if we take out that 38, 39 level. So just keep that structure in mind. Obviously the converse is, if we cannot hold the bid and we cannot break these 38.82s, or if we break and we just hold that offer back down again, well then, you know, nothing's really changing. You know, the overall long-term trend is still to the downside, in which case potentially really what you would look for as a bear is to take this level around 29.40s. You can see it's been acting as pretty strong support in there, other than these tails, and then a building of a bit of value in here before we move down. That's, again, buying tail region. I expect it to fill in. So that's how we're looking like in the oil. Moving over to copper, just to close this up. Copper had a bit of a false break of an larger time frame inverse head and shoulders, as you can see in here. Smaller right shoulder, not the best, kind of a Quasimodo type inverse head and shoulders, but we didn't quite close above. Really what you're looking for is a really strong, strong candle close above these two 214s, in which case if we get that, then we're looking at possibly a move quite a bit higher. We've held bids above the $2 mark. We've come and found a low at 193.65s. Just keep an eye out on this, obviously, because this is a very important product to keep an eye on for a gauge of what China is doing. So that's pretty much what I wanted to go through today. Obviously, I do have our second PLT intake, price ladder training intake this week, so that's going to be quite exciting to start. The guys that have started last week, doing an excellent job and following everything really, really well, so I'm really, really glad with that. And tomorrow I will be doing another price ladder analysis stream as per every Tuesday at 12 o'clock, so stay tuned for that. Right, guys, thank you guys very much for listening in, and have a very good and profitable week ahead. Bye-bye for now.